So everybody sees on the screen there is a brain teaser up here. I'm going to start with that, and then we're because I find this pretty interesting. So this is showing you Bill, who is retired. He has a taxable income of $48,988, and he's currently in the 22% tax bracket. And his income includes $40,000 in IRA income, 37,500 in Social Security benefits, and he decides he's going to go to a concert, and he needs an extra $1,000. So he's going to tap into his IRA for an extra $1,000 for a concert road trip. How much tax is he going to owe on that $1,000? Next slide, Matt. Okay. So he pays 22 cents in federal income tax for every additional dollar. Therefore, if he took $1,000, it appears he should owe $220 on that withdrawal. Next slide. Wrong. He actually owes $407 in tax. That's 40.7% tax rate on that income, even though he's only in the 22-cent tax bracket. This illustrates one of the tax oddities or tax quirks in the tax law that affects retirement. So the seminar we're seeing right now is how tax planning changed through 4 stages of retirement. So we could try to avoid different tax traps that are out there that we might be unaware of. Next slide. Okay. So obviously, this presentation is given by Matt and myself. Our address is 1400 Old Country Road, Suite 408, Westbury, New York, 11590. The office number is 516-338-4888. Matt put this on there, so we have Matt's email address, which is matthew.mahabadi@ceterainvestors.com. Next slide, Matt. Okay. So when it comes to tax planning retirement, the first thing we want to talk about is we are not accountants, we're not CPAs, so everyone should seek professional tax guidance when making any tax which has any tax implications for their retirement. But we're going to talk about it here, and the purpose of us talking about it is to guide you to see what tax traps are, and then either you can consult with your tax preparer or consult with us on what questions to ask your tax preparer and how different things will affect it. But looking at traditional IRAs, on a traditional IRA, you pay tax on your distributions or on conversions at ordinary federal rates and state tax rates. On a Roth IRA, it's non-deductible. The money grows tax-free, and earnings may be withdrawn tax-free in accordance with IRS rules. And state taxes, everyone here who's on this I believe everyone on is a New York resident, but if there are people on this webinar who are not New York residents, every state has a different tax rate, and there's certain states who have no taxes, like Florida, for example. There's no state income tax in Florida. So this presentation here is only going to talk about the implications on the federal tax bracket, but everyone will owe state tax as well. Next slide. Okay. So we're in a new complex world and at retirement. Here, there's a number of changes that have happened. The taxes in accumulation phase are very different from the tax phase or the spending phase of retirement. We lose a lot of tax deductions like child tax credits, mortgage interest deductions. A lot of times we have our mortgage paid off. The tax-free employer-paid medical insurance, contributions to 401k or other retirement plans are no longer applicable. And what is implemented now is we have to pay tax on our Social Security distributions, our required minimum distributions, RMDs, and we have to pay for Part B of Medicare and possibly long-term care. Next slide. Okay. So what's the first thing I need to understand about retirement and taxes? Next slide. So the first key, and there's going to be a number of keys we're going to go over. The first key is you have to know what your after-tax retirement savings picture looks like before retiring. Next slide. So let's talk about, assuming that you've saved $500,000 in your 401k, your IRA, your 403b, any other tax-deferred plan that you have through work, it's not really $500,000. If you're in the 35% tax bracket, $500,000 is really equivalent to $325,000. If you're in the 37% tax bracket, it's equivalent to $315,000. In addition, you're required to withdraw minimum distributions, your RMDs, each year after you turn 73. And for those of us on the call who were born after 1960, it's 75. Next slide. So that has a very big impact over time. So let's assume you had $500,000, and let's assume it was earning 6% a year on average. And let's see how if it was earning 6% on average, and let's see what the effect of that would be if we're in a zero tax bracket and we had that money sit for 25 years, from age 70 to age 95, at a 0% tax bracket. That amount, your distributions, your cumulative after-tax distributions, you would still have in your pocket to spend over $900,000 just from that $500,000. You would have collected $900,000 in spendable money. Let's assume you're in the 12% tax bracket. Well, now it's a little bit over $800,000. But let's assume you're in the 33% tax bracket. Now you've only had about $600,000 in spendable money. This is the same exact investment, getting the same exact return. How much did that impact you? The difference between $900,000 and $600,000. Next slide. And you might say, okay, but at least I still have Social Security to supplement my income and Medicare costs to pay for my healthcare costs. So let's go to the second key now. The second key is Social Security and Medicare have their own tax traps, and we need to prepare for them also. Next slide. So let's talk about how Social Security and taxes work. So I'm going to use that. I'm going to use the example. Go back to that tax teaser that we had in the beginning, that brain teaser. So remember, Bill, he has $40,000 in IRA income. He had Social Security benefits of $37,500. His adjusted gross income, and this is how much actually are taxable, was $65,538. So his taxable income after his deductions were $48,988. So that left him with $5,830 he'd have to pay tax. But once he took that extra $1,000 once you got extra $1,000, now his adjusted gross income actually, because of the way it's calculated, went up not by $1,000, but it went up by almost $1,800. So his adjusted gross income was $67,388, and results in a taxable income of $6,237 for the year, as opposed to $5,830. Next slide, Matt. Okay. So as I just said, that's $1,850 difference in his income, even though he only took $1,000 out. So for every additional dollar he takes out of his IRA, once he hit that number, because he changed the way Social Security is taxed and his tax bracket tax, he's paying $1.85. $1.85 is added to his adjusted gross income for every dollar he takes out. Next slide. That's why we call this a special tax, Social Security tax torpedo. He wound up owing 40.7% on that extra $1,000 he took. And that's based on his stated marginal tax rate of 22%. If he was in a higher tax bracket, he was close to another bracket, he actually could have been even more. Next slide. So let's talk about Medicare and taxes now. And the second thing we want to look out for is what we call the IRMA cliff. And we're going to talk about George and Martha. George and Martha have planned very well for retirement. They did very well in life, and they have a pretty decent retirement income. As a matter of fact, their modified adjusted gross income in 2022 was $322,200. So they're having a comfortable retirement. They have Medicare Part B, and they have the drug plan, Medicare Part D. George and Martha decided to sell a stock that they own, and that had a $1,000 capital gain. So typically, we'll think if they have a $1,000 capital gain, their capital gain rate is 15%, but they also, because of their income, there's an additional 3.8%. So they should owe 18.8% on that. Next slide. No, and that's why they hit an IRMA cliff, because their income was very close to that bracket. For everybody pays at least at a minimum $174.70 out of their Social Security check for Medicare Part B. But when your income is of a certain level, they have the IRMA kicks in. And the IRMA, for someone who's married and filing jointly, who makes $322,000, was paying $349.40 out of their Social Security check each month for Medicare Part B. But just by getting that extra $1,000 in capital gain, that small amount of capital gain, that $100 and something they got in capital gain, caused them to increase to $454.20 per month. And that's each one of them. Next slide. Okay. So now it also affects their Part D, and their Part D premium went up from $33.30 out of each Social Security check to $53.80 out of each Social Security check. Next slide. So when we look at husband and wife, how much comes out of their Social Security check now in addition to what was before, based on having that extra $1,000 capital gain, cost them $3,007.20. So for selling a stock at $1,000 gain, cost them $3,000 less in the Social Security 2 years later. IRMA kicks in not the following year, but 2 years after. Okay. Next slide. Okay. Okay. So that comes out to 319.5% tax rate on that extra $1,000. Imagine that, 319.5% tax rate. Now, so this is why it's very important when you're retired, and you're going to have, do some move to first go over it with us, but then we might direct you to your accountant, because how close you are to that next bracket could mean all the difference in having to pay a huge amount of tax for that small amount of gain. Next slide, Matt. So let's talk about another problem that might happen with Medicare. So this is example number 3. Jim and Ann are both 68 years old. Jim retired when he was 65, and Ann 1 year later at 66. They get coverage through Ann's employer, who offered retiree health insurance. When should they enroll in Medicare Part B? Next slide. Okay. So the one thing that you have to remember is you can't get Medicare coverage instantly. If you miss the enrollment period, there's a 10% penalty. And that's not just a month, that's for the rest of your life. Every month, you're paying a 10% penalty. So for 2024, where you would be paying $174.90 for Part B coverage, this person is going to be paying $17.49 a month times 12, or $209.88 a year for both husband and wife, or $420 for the couple every year. This could translate into over $10,000 that they're paying extra just because they did not apply for Medicare Part B on time. So and they might have a gap in coverage because they didn't apply on time. So it's very important that we apply for Medicare on time. Next slide. Okay. So this person saying, wow, there are other tax traps we're facing retirement. Yes, there are. Let's go to key number 3. You must plan how and when to use taxable, tax-deferred, and tax-free assets to manage your income and your tax brackets efficiently. Next slide. So one of the things you can do is you consider Roth IRA conversions. And when you have a traditional IRA, you can convert money to a Roth by paying the income tax on that money. The taxable amount is converted and added to your income for the following year. So Jill converts $100,000 from IRA to a Roth. Jill would have to add $100,000 to her income, which would probably put her into a higher tax bracket, and she'd have to pay a lot of tax to do that. And because that conversion is taxed at her current rate, which probably is a higher rate after taking that much income in 1 year. Next slide. Next slide, Matt. So the way to do this is you want to fill up the bracket. So let's assume before you convert, you're in the 22% federal tax bracket. That means that part of your income is taxed at 10%, part of your income is taxed at 12%, and the last portion of your income is taxed at 22%. But only a portion of that bracket is filled up. That means that there's still more money you could make before you're in the 24% bracket. So what we might consider is, let's say between the time you retire, let's say a person retired 65, and you have to start taking your RMD at 73, you might consider at that point, in that gap time, to convert every single year enough to bring you up to fill that bucket, to fill the bracket. And so you get the maximum amount that you can convert without putting you in a higher tax bracket. And that is a nice strategy you can use, especially now that they push back the age that you're forced to take your required minimum distribution on your IRA or other retirement plans to 73, and for those born after 1960 to 75. It gives us a period of time from when we retire to when we have to start taking that money to convert slowly, without paying a lot of tax, into a Roth IRA. Next slide, Matt. So other possible things that we can do is we could withdraw money from life insurance policies to keep our income low. We could sell highly appreciated stock at the same time that we're selling a stock at a loss and a gain, so we could offset the capital gains. We could take advantage of distributions from IRAs or 401ks when we're in a lower tax bracket for a particular year to take advantage of that. So there's different things we can do to manage our tax brackets. So one of the things that Matt and I do with clients is when people ask us, where should we take money from? If they need money unexpectedly, a lump sum, we'll try to come up with the right amount for that there. And sometimes we might have them consult with their tax preparer to see how much they have in different brackets where they're going to fall. Next slide, Matt. Other strategies are before you retire, you can use a health savings account to lower your tax and pay for some of your health expenses. You could use, if you have your own business, this thing called qualified business income deduction after funding a company pension. That might be available for some people that have their own business before they retire. Next slide. So here's a very interesting one. Everyone knows, or most of us know, that we're required when we turn 73 or 75 to take our required minimum distribution from our IRAs. Well, let's assume that you regularly give money to charity, or you have a bill that you pay to a church or to a synagogue, and every year you're given the same amount of money. You can take a distribution from your IRA and give that to the charity, and that allows you to not have to pay tax on that distribution. Many people who are going to give money will take an RMD, donate money, they pay tax on their RMD, and now they could take money and have it sent without any federal income tax. So that is something that a charitable giving and tax planning can come into play. And if you think this affects, might affect you, or how it can be used, that's something we could talk about. The next slide, Matt. Next slide. We actually call this a qualified child distribution, or QCD, and it's available to anyone after 70 and a half that they can do. And you can give up to $100,000 from an IRA direct to a charity. It counts as an RMD, but it's not reported as income. So you can take more than your RMD. In this case, this allows you to transfer money to a charity without having to pay tax on that distribution from your IRA. Next slide, Matt. Okay. So if we're just looking technically how it works, in this case, the charity got $5,000. $5,000 satisfies the RMD. $7,000 is reported as taxable income, but it's wiped away, and the tax bill on a distribution of 24% would have been $1,200 otherwise. So the cost of giving that money, giving $5,000 if you don't use a QDC, was $6,200. If you use a QDC, next slide. If you use a QDC, you took the $5,000 out, but you didn't have to pay the $1,200 so it only cost you $5,000 to give $5,000 as opposed to $6,200 to give $5,000. Next slide, Matt. Okay. So, first, I hope to have assets to pass on to my family. How does retirement tax planning figure into this? And this is very interesting. You want to organize your assets in such a way that your family benefits from estate planning. It still matters, regardless of whether you have, $20 million or you have a relatively modest amount. One of the things, let's assume a person has an existing long-term care, existing life insurance as a long-term care rider. The premiums may be deductible at the federal and state level. The payments from policies for reimbursement of long-term care expenses are tax-free. And choosing how to pay for long-term care costs can have a big impact on their heirs. Let's give an example here. Go to the next slide, Matt. Okay. So this is an example where Florence is a widow. She qualifies for long-term care benefits from a hybrid policy that she took out a number of years ago. She receives in-home care benefits that are equivalent of $60,000 a year. She has $20,000 a year in Social Security, and she has $400,000 in her existing IRA. The life insurance and long-term care rider right now has a $500,000 death benefit to her children upon her death, or she could take up to $10,000 a month for long-term care costs. Next slide. Okay. So if Florence uses a long-term care policy to pay for 5 years worth of care, Florence pays no income tax during the last 5 years, high deductibles for unreimbursed medical expense. Her long-term care insurance pays $300,000 in home care, $60,000 a year for 5 years. The kids inherit the remaining amount of life insurance of $200,000, as well as the $400,000 that is taxable from an IRA. But if she does it slightly different, next slide. If Florence uses the IRA to pay for the long-term care, Florence pays little or no income tax during the last 5 years because of the high medical expense. She uses the IRA money. She takes $300,000 from IRA to pay for that in-home care, that's $60,000. And now the kids are inheriting $500,000 income tax-free because life insurance is income tax-free, as well as $100,000 left over that's taxable in IRA funds. So the kids are getting $500,000 tax-free and only $100,000 that's taxable. Next slide. Okay, so in this scenario, the comparison is by using $300,000 taxable money versus the $300,000 tax-free money, she winds up with giving her children a lot more money after she passed away, and the bills were still paid for. So when does that make sense? In certain circumstances. When doesn't it make sense? In certain circumstances. So that's why managing your taxes in retirement has many nuances. Every single person is different. Every single recommendation will be different because everyone can benefit from certain types of advantages and loopholes. Next slide. Okay, so as all of you probably are saying, goodness, how are we going to manage all this? It's very confusing. And it is. So I'm going to just review a few things. Pre-retirement, you want to know what your after-tax savings are before you retire, and you want to try to fund Roth accounts if you can. For those of you that are still working and you have an availability of having a Roth 401k or Roth IRA or Roth 403b, if they're available, take advantage. Starting next year, all matching contributions on 401ks are required to go into a Roth account. For those of you who don't have a Roth option, your 401k, because of this, it should be available starting next year. Early retirement. You want to understand how Social Security and Medicare taxation works. In your early retirement years, you want to fill the tax brackets to convert money into a Roth in your low-income years. Middle retirement, you want to manage and plan how you use your RMDs. And late retirement, you want to organize your assets for tax efficiency, especially in passing on assets to your children. Next slide, Matt. Okay. So because your tax exposure will change throughout your retirement, you need a strategy that anticipates how and when you will be tapping assets to cover your personal expense. And you want to understand the range of tax you'll face at various stages. And you want to manage your actions so you pay the lowest tax rate possible. Next slide. Distribution spending phase is complicated. Managing your taxes happens throughout retirement. Mistakes can be costly. The education strategy and advice that's needing is what Matt and I can provide you in consultation with your tax preparer. So for those of you who something to spark something and you need something more in depth in your particular tax and retirement distribution strategy, Matt and I are more than happy to go over any of those strategies with anyone. You could just let us know, and we're more than happy to set up a time for us to review that with you. And the last slide, Matt, questions. So, okay. So at this point, if you do have any questions that are sparked now, you can put them in the chat, type them in the chat box. Matt's going to be looking at the chat box to see if there's any questions there. If not, you think of questions later on, or you want us to go over any aspects you heard in this,